Dumela. Let us do the whole of question 1 from June 2023. This is Department of Education, Basic Education. And question 1 is all about the statement of profit or loss and current assets. In 1.1, you need to choose a description from column B that matches the term in column A. Write only the letter which is A to E next to the question number. 1.1 to 1.4. Basically, this is what you are given in the answer book. You just need to write the letter what matches 1.1. Is it A, B, C, D, or E? All right. Let's start with 1.1. It says an independent auditor. Remember, an independent auditor is an external auditor. We also call them an external auditor. It is basically a company of which is a partnership, but obviously we don't have partnerships anymore. And it's either that person is representing one of the auditing firms in South Africa. You know that to be an independent auditor, you must first be a chartered accountant and then write your board exam with IBA. Then you can become an auditor. And they just express an opinion on the financial statements. It's not an absolute assurance. It is a reasonable assurance that the financial statements are either fairly presented or not fairly presented, or basically they're fairly presented with certain material misstatements. And for this one, I'll just say 1.1 is E. 1.1 will be E, right? Let's go to the second one. A capital employed. Capital employed is simply non-current liabilities plus your shareholders' equity. And remember, shareholders' equity is made up of ordinary share capital and retained income. And so 1.1.2 will be what? Let me read the definitions that we have. Investments such as a fixed deposit over a 3-year period. Nope. Debt to be settled within 12 months. That is a current liability. A staff member of a company who sets up effective internal control procedures. That will be an internal control. Total of ordinary shareholders' equity and non-current liabilities. So basically, 1.1.2 will be D. Guys, it's very important for you to know definitions, all right? And as I've shown you, for 1.1.3, it will be B. And 1.1.4, financial assets, it's just your investments, such as fixed deposit, which is an investment because it is a non-current asset. It's a non-current financial asset, and that will be A. All right. Obviously, see, guys, that's an internal auditor. They work for the company, they're salaried employees of the company, and they need to set up effective internal controls, procedures. Now, when you set up effective internal control procedures, it means that you need to come up with internal controls that will prevent certain risk. And a risk is any threat to the company that will, well, any threat to the company's profitability, future profitability, or even current profitability. So you set up effective controls that will prevent such a risk from happening. Okay? And that'll be it with respect to matching column A and column B. Now we have Starlight Limited. The information relates to the financial year ended on the 28th of February 2023. So that is the end of our financial year. The company trades in electrical items. Okay. Let's start with 1.2.1. They say refer to information BI. Calculate the value of closing stock of light bulbs on the 28th of February 2023 using the weighted average method. Now there you need to remember the formula for calculating weighted average first. So to calculate the weighted average cost, it will simply be your opening value of stock plus your purchases value of stock minus the returns value of goods returned, and then you add your carriage on purchases, you add your customs duties, you add yeah, any directly attributable cost that relate to that stock. Then you divide by the number of units opening plus number of units purchased minus number of units returned. And in the denominator here, there you can also add gifts. Okay. So if we buy 5 items from this company and they decide to give us 2 items for free, so that will be gifts and it will be in the denominator. Ultimately, gifts value, the number of units that we were given for free will reduce our average price per unit or average cost per unit. Now, the opening value of stock. Let's read as to how we're going to get that. Okay. I just gave you the formula there. I don't know what the value of stock was. So I'm just simply gonna go back and check what do we need. Here they gave us the balance sheet. I see the trading stock there. I don't think that will help us. Um, I don't think it'll help us. They just gave us the value of stock, which is 2,969,800. That is the value of stock in our books at the end of the financial year. But we need to compare that to the stock that we counted. I don't see anything that can help us here. Oh, there it is. They say to you a physical stock count on the 28th of February 2023 revealed that we had 2,774,800 stock on hand. So normally we'll take this and compare it to the stock that we have as per the trial balance, which is this one here. But before I can even try to compare, let me just read further. Then they say, however, this figure excludes the closing stock figure for light bulbs, which is light bulbs are valued using best not weighted average method. Okay, I just gave you the formula now. Know that the weighted average method is used to value the light bulbs, and they repeated that again to make sure that you get it. So we're not using first in, first out method. We're using the weighted average method. And they gave us the details. They gave us the units opening, which is 8,000 units value, which is 416 units purchased. It is 47,000, and that gave us 3,478,000. And then they gave us the carriage as well. But the stock, units of closing stock, it's 1,700. For us to find the unit price, you need to use the formula that I gave you, where you're going to take the value of opening stock. In the numerator, you add it with your purchases, all right? Okay, it wasn't necessary there because anyway, they gave you units available. So you will just take this one over here and add it with that and divide it by that. So that will give you a weighted average cost per unit. Let's see how much that will give you. Okay, here I broke it down and I also added the carriage on purchases divided by the number of units. You could have just taken the ones that I told you I gave you there. So units available for sale, it's simply balance at the beginning of the year plus purchases minus returns, which is that over there. So it was given to you, all right, which is all of that. So in this case, you'll take your numerator. When you add it up, it will give you 3,921,500 divided by 55,000, which is the one that I gave you above, and it'll give us a weighted average cost, which is 71,3. Now that 71,3, I'm just going to multiply it by the number of units of closing stock, which is 1,700,000, and that'll give us the value of our closing stock, and that'll be 121,210. Done. All right. I'm just looking for anything that is related to that value of closing stock. Obviously, I will need to record it in the income statement. However, I don't know if I'm going to record it under operating expenses or under operating income. But first, I need to find the value of my closing stock as per the stock count. I already have the value as per the adjustment trial balance. Let me check. Oh, yes. So this is where I will have to calculate it. So I will simply take the stock that was counted, which was given to you. It was, there it is, 2,774,800. So I will start with that value and put it under my inventory note. And I'll just have to add it with the value of stock that we just calculated, which was 1,700 times that 71 rand, comma 3 cents. And I will add it with that 121,210. It'll give me my inventory for the entire year. But this inventory, it is the one that we have counted. It represents the inventory that we've got. I need to take that 2,896,010 and compare it to inventory count or trading stock count, which is obviously that is this trading stock count. I'll have to compare it to the trading stock that is given to us in the pre-adjustment trial balance, the one that we have recorded, the one that relies on source documents will be compared to the one that we have counted. The one that we have counted, it's legit. We saw it. It's physical. So that is why we put it as our inventory because it's there. It's the accurate one. It is the correct one. You see this one that you have here and the pre-adjustment trial balance. It depends on the source document. If you bought stock on credit, it'll be in the creditors journal. If you bought it for cash, it'll be in the CPJ. If you sold it, it'll reduce it by cost price of goods sold for cash, which is the CPJ, cost price of goods sold on credit, which is the DJ. All of that will make that stock that we have there. So it's basically based on the source document. However, the value that I just gave you right now, it depends on the stock count. So that is the valid one. That is the accurate one. So this is inaccurate. And the fact that it's inaccurate, it means in our books, our stock is incorrectly valued. So we need to take it down to the value of stock as per the stock count. So we are going to take that 2,969,800 and reduce it to um, I'll reduce it to the stock that we've just counted. I did show it to you, which is 2,896,010. The fact that I have to reduce it, it means that we have trading stock deficit. So we're reducing our stock down. You reduce your stock down. That difference is a trading stock deficit. If you were taking it up to the stock count, the difference was going to be trading stock surplus. All right. Since it is a trading stock deficit, we are going to record it under operating expenses as such. Don't forget to write deficit. A lot of people just write trading stock. Know that if you write trading stock, guys, that is a foreign item. Actually, you're supposed to get -1. You need to include the word deficit or surplus if it's income. In this case, it's deficit because it's an expense. And it'll be the difference between the two values, and your trading stock deficit will be 73,790. Okay. The next question wants us to do what? They want us to calculate profit or loss on disposal of a vehicle as well as total depreciation for the year. Let's look for information relating to that that can help us with that. I haven't seen it so far. So the only thing that I saw is my pre-adjustment trial balance is I saw something about a vehicle here. Let me just go to the next one. There it is, disposal. So basically, this is the cash we received when we got rid of the vehicle, which is 91,500. Okay, we can't use that. Obviously, it affects only your bank. It'll basically just increase your bank. So that is the selling price of the vehicle. In the cash flow statement, that value will put it under investing activities as proceeds from the sale of an asset. Okay. But it doesn't help me when I prepare the profit or loss. It really doesn't help me. Um, on its own, it really cannot help me. I need that and compare it to the carrying value. The difference between that and the carrying value. If the carrying value is less than that 91,500, then we have made a profit. If the carrying value is more than that 91,500, then we have incurred a loss. All right. So that's what I'm going to do. I will need more information. And this is the only information I'm getting. They say it's fixed assets and depreciation. An old vehicle was sold for 91,500 on the 30th of November 2022. The amount received was recorded, but no further entries were made. We know that. We saw it. It was 91,000. I just showed it to you not long ago. And then they gave us the details of the vehicle sold. So on the 1st of March, the carrying value of this vehicle was 104,000. And then it was depreciated at 20% per annum on the diminishing balance method. Interesting. And then they gave us depreciation on the remaining vehicles, which is 145,200. But they didn't give us depreciation of this vehicle that was sold. The fact that it was sold on the 30th of November, you need to count for how long you've used this vehicle. So it was there from the beginning of the year. So we had it from March 1, April, May, June, July, August, September, October, November. That gives me 9 months. Note that when we depreciate depending on how long we have used that asset in the current financial year. The only thing that they gave us is the carrying value at the beginning of the year, which was good because that carrying value can enable us to calculate depreciation on this asset for the current year. But for you to do that, you need a timeline. Guys, please draw the timeline, which starts on the 1st of March 2022 and it ends on the 28th of February 2022. But on the 30th of November, it's when we sold this vehicle, meaning that for the current year, we used this vehicle only for 9 months. Okay, we are given the carrying value of the asset at the beginning of the year. For us to calculate depreciation, they said we depreciate on diminishing balance method. So you just need the carrying value of the asset at the beginning of the year. If it was on cost, it was going to be a problem. Okay, because we don't have the cost price. The only thing that gave us is the carrying value at the beginning of the year, which was 104,000. You're going to take that and multiply it by the depreciation rate, which is 20%, and then multiply it, apportion it by multiplying it by 9/12. Please note that that 20% is per annum. It's for the whole year. It's not for per month. It's for the whole year. So for us to apportion it to make sure that it's only allocated for a specific period over which we have used this asset, we are going to multiply it by 9 and divide it by 12 because it's per annum. We'll divide it by 12. And that'll give us depreciation on this vehicle, which is 15,600. Now, please know that depreciation will reduce the carrying value at the beginning of the year. Okay, depreciation reduces the value of an asset. So I'm going to take that 104,000 and subtract 15,600. It'll give me the carrying value on the date of sale. DOS stands for the date of sale, which is 88,400. You see, now with this, I can use that selling price that was given to us, which was 91,500, if I'm not mistaken. So you're going to take that and minus that carrying value of 88,400. If the answer that you get is positive, then we made a profit. If the answer that you get is negative, then we incurred a loss. Here we made a positive value. So we sold these assets for more than its carrying value. So we made a profit of 3,100. That 3,100, we are going to put it in our income statement under operating income as profit on sale of a vehicle or on sale of an asset. And that will give us 3,100. Okay, 3,100 will be the value of the profit on sale of this specific asset. All right, that's it with respect to that specific asset, but they said depreciation as well. Let me just go back to the question and check what they meant by depreciation. So they want us to calculate total depreciation for the year. We've already calculated depreciation of the asset that was sold. Okay. So now we need to calculate total depreciation for the year already. For the remaining vehicles, they said it's 145,200. I'm going to add it with the depreciation we got for this asset, which was 15,600 of the assets sold. Now we're left with equipment. Now for equipment, we're depreciating at 15% per annum on cost. And they said there was a new equipment that was bought on the 31st of July, 2022. So now this will take me back to my pre-adjustment trial balance, okay? I've got vehicles, okay, they didn't give it to me. Accumulated depreciation, they didn't give it to me, but they gave me the cost price of equipment for last year and this year. But for accumulated depreciation, they only gave me last year's one. So I know that this equipment here, I've had it for the entire year. So I'm just going to take that and multiply it by 15%. It was 15%, right? And multiply it by 12 over 12. Okay. The problem is the increase. The increase was not there for the entire year. Okay. Um, it was purchased during the year. So let me just focus on that, guys, quickly. Okay, let me just focus on that. For vehicles, we have calculated this already. Is depreciation of the remaining vehicles plus the depreciation of the sold, which will give us the depreciation on vehicles. For equipment, we have cost at the beginning of the year, which is 774,000. We had accumulated depreciation at the beginning of the year, which is 360. The carrying value at the beginning of the year for equipment will be 414,000 thousand. I mean, for 414,000. I don't know what I'm trying to say there. It's just that my mind is running so fast. I'm thinking too fast and I'm not even there yet. Because my next question, my train of thought is just moving too fast. My next question was, why though do we calculate carrying value at the beginning of the year when we are depreciating using the cost price? The reason why we are depreciating at the beginning of the year, it's because we're calculating carrying value at the beginning of the year. It's because we don't want current year depreciation to be more than the carrying value at the beginning of the year. If it is more, we limit it to carrying value at the beginning of the year minus one. So here I'm going to take the cost price, which is 774,000. And when you take that 774,000, they'll give you 116,100, okay? That will be the depreciation of the old equipment. Now we're going to have to figure out what the cost of the new equipment is by taking the cost at the end of the year minus the cost at the beginning of the year. It'll give you the cost price of the new equipment, which is 48,000. But this 48,000, for how long have we had it? When was it purchased? If I remember very well, they said in June, July. So it was purchased on the 31st of July. So meaning that we had it from August, September, October, November, December, January, February for 7 months. Okay. As I'm counting these months, you must just know that I'm using my fingers. It's basically August, September, October, November, December, January, February. That is 7 months. I double checked. It's 7 months. So I'm simply going to take that 48,000 multiplied by 15% and then multiplied by 7 over 12. It'll give me depreciation of the new equipment. So when I add the depreciation of the old equipment with the depreciation of the new equipment, it'll give me total depreciation on equipment, which will be 120,300. And now I will add depreciation, the total depreciation of all vehicles with the total depreciation of all equipment, and that will give me my total depreciation for the year. And that will be 281,100. Now that depreciation, what am I going to do with it? It goes under operating expenses as such, which is the sum of the two. And it'll give me 281,100. Done. Just like that. Okay. Am done with that. What is the next question? What do they want in the next question? They basically just want us to complete the statement of comprehensive income as well as the current asset section of the statement of financial position. I don't normally call it the statement of comprehensive income. I call it the statement of profit or loss because comprehensive income is the bottom part of your statement of profit or loss because it includes other comprehensive income, which is a little bit beyond your syllabus for now. You will learn about that when you get to your second university. Probably 30, I don't know. They told you that some figures have been entered in the answer book. Okay, I'm just gonna shoot straight to my income statement and check what I need there. I will just go through this as I need stuff, okay? I will start with my adjustments first, which is I normally don't do them this way, but I'll just start with my adjustment in this specific paper. They say that the auditors are owed a fee at 38,800. Now that should increase our audit fees and it should also increase our trade and other payables. I don't think we were given trade and other payables here. So, but I'm just going to take it to our audit fees. In the pre-adjustment trial balance, our audit fees were given to us as how much? That's why I'm saying that I'm doing it differently. Normally, I will just go to my pre-adjustment trial balance and enter everything that is there in my statement of comprehensive income. Okay, so that's what I will normally do. But let me just go to my pre-adjustment trial balance here and look for audit fees. Audit fees there are sitting at 155,200. I have to increase that by 38,800. So my audit fees must be increased by 38,800. That 38,800 is accrued expense. And accrued expense will be recorded in trade and other payables. If I remember very well, they said they only gave us the current assets part, of which trade and other payables are not there. Good for us. Let us move on. What does the next question say? Okay. Adjustment. Sorry for that. They say we received 9,000 rand from the insolvent estate of Billy Kroon. His estate paid 80 cents to the rand of his outstanding balance. The money received was recorded. The balance of his account must still be written off. So that 9,000 rand, guys, is the 80%. It is the 80%. Don't take it and multiply it by 80%. It's not the amount owed. It is the 80%. 80% is what we received. 80%, when I talk about 80%, guys, just know that I'm talking about 80 cents. It's the same as 80%. And meaning that we did not receive the 20 cents. That 20 cents is the one that we need to write off as bad debts. So that 20. So that's why I normally say you multiply by what you want, you divide by what you have. Please check out my videos on General Journal. It's that there on YouTube. Or check out my videos on bad debts. I did them, I think, for under adjustments as well. I think I did them under adjustments as well. Check them out because I discussed that in detail. So what I'm going to do is to take the 9,000 rand, multiply it by 20 and divide it by 8. It will give me my bad debts. So according to the pre-adjustment trial balance, my bad debts are currently sitting at 16,200. So they have to increase by 20 over 80 of 9,000 rand. And that will go to my statement of profit or loss as such. So for bad debts, I'll take 16,200 and increase it. It increased by 20 over 80 of 9,000 rand. So in total, my bad debts will be 18,450. But that 20 over 80 bad debts reduces your trade and other receivables, okay? Because it means those people will not owe you anymore. They have to be written off. And your trade and other receivables, I'll just have to go to the statement of financial position part of your pre-adjustment trial balance. And there I have my debtors control of 645,000. I don't see any other current assets there. And all I'm going to do is to take that value, right? That value. Actually, I do see another current assets. It is this one that relates to provision for uh, provisional payments, sorry, which is 875. But we'll get to that when we do tax, okay? So I'm going to take that 845 and reduce it by the amount of bad debts, and which is that 9,000 multiplied by 20 over 80, which is simply 2,250. Done with that. Done, guys. Let's move on. The next one says provision for bad debts must be increased to 25,720. Provision for bad debts is calculated on good debts, or simply the balance of your debtors control after taking out all the bad debts and everybody else, okay? Or all the information relating to debtors control. You're going to compare this to your provision for last year. And your provision, or at the beginning of the year, your provision for last year is currently sitting at 21,020. So that provision has to be adjusted at the end of this year to 25,720, which is higher. So because it's higher, your provision, the difference will be written under operating expenses as provision for bad debts adjustment. Firstly, I'm going to take the final amount of your provision must go to trade and other receivables, and you need to subtract it from trade and other receivable, which is the one that you calculated, or the one that was given to us under adjustment. So you will take that 25,720 and subtract it from your debtors control. And then you start comparing. As I've said, because our provision is going up, that 25,700 and 720, it is the correct provision. So the one for last year needs to go up. And when the provision is going up, that's bad news, bad news, as it means that we are increasing the estimate of future bad debts, and that is bad news for us. That's why the provision for bad debts adjustments has to be recorded under operating expenses. Find the difference between the two, and the difference will be 4,700. Done. Right. Let's move on. Then they say the director's fees. Oh, this one I liked. audit. I really, really like this question. I think I'm going to put it in one of my um, tests and exams this year. I always say to people, I know that people normally, I know this video will have lots and loads of views, but people probably are ignoring videos that I've made based on IB papers. Guys, I know that IB educators will tell you that IB is difficult and blah, 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 blah. Guys, to me, because I taught in both systems, the Department of Education, I spent 5 years there, and currently now I'm on my 6th year in IB. I really don't see any difference except for the layout. Obviously, the layout is a little bit different. But accounting is accounting, guys. Whether you studied at Wits, UP, or UJ, or UKZN, or Stellenbosch, accounting is accounting. An asset doesn't change. It's still an asset, a resource controlled from past events. We use it to make money or to generate future cash flows. It doesn't change. It's still the same. Similarly here, whether we are DBE or IB or what is the other one? A level, all of these are the same to me. Accounting is accounting. Okay, let's read this. They say I'm going to steal this and I'm going to put it in the format, IEP format. It's so nice. I'm not stealing it. I'm taking it. Yeah, difference. Yeah, I'm taking it. It says that the company has two directors who were appointed in 2019. I don't think that matters. So they're telling us that these guys have been there from the beginning of the year. 2019 is a long time ago. They're just telling you that these two directors were there from 1 March until the 28th of February 2023. That's what they're telling you. And then they say a third director was appointed in October. Okay, good. Okay. So I've got 2x. I've got 2x times 12, and I've got 1x times in October. It's October, November, December, January, and February. So I've got X times 5. So this third director was there for 5 months. So 2X was for the entire year, and then this 1X was for 5 months. Okay. And then they say all directors earn the same monthly fee. Whew, that's good. So I don't need to worry about adjusting up and down. On top of this, I'm dealing with two directors here that end at different points. And imagine if they said they were earning different amounts. Oh, it was going to be something else. Oh, but that would be nice, though. Imagine if I say the new director's salary, the new director's, their director's fee was increased by 10%. Oh, that would be great. That would be great. And so see too. And then they say to you, director's feed pays during the year have been recorded. Okay, so all these director's fees were recorded, but one director has already been paid for March and April. Oh, that is a problem. So we've got two directors, right? That were there from beginning to the end. So I'll have 2x times 12. And then I've got one director that was from there from October, that was there from October, which is October, November, December, January, February, March. It's actually it's not even March, it's just up to February. So they were there for 5 months. So it's X times 5. And then on top of that, I've got X times 2. So one of these directors was paid for March and April. So that's why I'm going to say X times 2. When I add all of these, they must give me my director's fee, guys. Okay, which is the one that is in the pre-adjustment trial balance, and that will be 2,015,000. Okay, I know someone is like, yeah, but we're doing mostly, guys. You did solve for X in grade 8. When I did this, I'm teaching grade 8 maths. When I did this, I'm just applying grade 8 maths. That's all I'm doing. Anything you don't know, you call it X. So let me just give it to you guys as a picture. I think I've done this one. I didn't even know that I have workings for it. Well, that's good. I have workings for it, and I even have explanation. Wow. Okay, let's focus on director's fees. I've got 1 March up until the 28th of Feb, but something happened in October. We appointed another director. So we have two directors that were there for 12 months. And then we've got this one director that was there only for 5 months. And then we've got two directors. We've got one director that was paid for March and April. So basically that will be 2x. All of this must give us director's fees of 2,015,000. Guys, by now you know when you multiply this, you're going to times 2 with 12. It'll give you 24 plus 5x plus 2x. Okay, so you will end up getting 24x plus 5x plus 2x, which is the same as 2,015,000. 24 plus 2 gives you 26 plus 5, it'll give me 31x, which is the same, which must equal that 2,015,000. And then you divide by 31, it'll give you each director's fee, which is 65,000. But one director was paid for April and March. Those two are very important because we don't want them. They fall outside the financial year. So I'm just going to take that 65,000 times 2, which will give me 130. That 130 represents expense prepaid. Expense prepaid. So I'm going to take my director's fees and subtract that value. So where is my director's fees? Which is 2 million and 15,000 minus that 130,000 because it doesn't belong to the current financial year. It was prepaid. And the fact that it is prepaid, I am going to include it under trade and other receivables. I'm going to add it there. It's a current asset. It is owed to us because we have paid this director. So this director better do a good job for the next 2 months of the next financial year. We're still good, right? Easy, right? Just like Nasty said. I know counting can be a little bit nasty, but break it down. You see? Yeah. If you get it, you get it. If you don't, read between the lines until you get it. Done with it. And then I'm gonna go to rent income. Includes rent for March 2023 received from the tenant. The monthly rent was increased by 1,170 on 1 January 2023. Guys, I've got rent adjustment videos. Please, please, please check them out. You can't do this without drawing a timeline. So our financial year started on 1 March 2022 and it carried on until March 2020, until February 2022. And then we know that we also received rent for March, but they told us rent was increased in January by 1,170. And that means 1 month fall outside the financial year, and we need to take it out, which represents prepaid uh, well, it's income received in advance or deferred income. But now, how much was rent before the increase? It was X, but for how many months? That is March, April, May, June, July, August, September, October, November, December. I won't count January because they said it was increased on the 1st of January. Am I right? Yes, it was increased on the 1st of January. So it means that it was 10x. Okay. From the 1st of January, it was for January, February, March, 3 months. For 3 months, it was X plus 1,170. Okay. All of this must give me my rent income that was received. And that rent income, I will get it from my pre-adjustment trial balance. Excuse me. And that'll be 89,700. It must give me that 89,700. So I'm just going to take that and equate it to 89,700, which now gives me an equation. It's a linear equation. So to break it, guys, you'll just have to take 3 times it by x and then take it 3 times it by 1,170. So this is what I will get, which is 89,700. Then transpose that 3,510 to the other side. But before that, just add these two that will give you 13x, and then transpose that 3,510 to the other side by taking that 89,700 minus it, minus 3,510 from it. and you will get the value of 86,190. And you'll take 86,190 divided by 13. It'll be it'll give you 6,630. That is our rent for the 10 months from March 2022 until December. But after December, it wasn't 6,630 anymore. So I'm going to take that 6,630 and add it with the increase, which was 1,170. And let's see how much will that give us. So you will have 6,630 plus 1,170, it'll give us 7,800. That 7,800 was the rent per month from January, February, March. But we don't want the one for March, okay? So it must match out. We don't want it, okay? It must match out of our rent income for the year. So that will be the one for March is what we call deferred income. Normally, deferred income, we will take it to trade and other payables, but we don't have trade and other payables here. So I'm going to start with my rent income, which will be 89,700. You subtract that 7,800, which is for March, and that will give your rent income earned will be 81,900. Now you're going to add all of these, it'll give you your other income, and then you take your gross profit, you add it with your other income, you will get your gross operating income. Got it? You sure? I hope I wasn't too fast there. I hope I wasn't. This is fun, actually. Kind of enjoying it. I hope you are too. So you add this with that, it gives you this. Then you add this two. So you add these two, then they'll give you that. Got it? Am I done though? I don't think I am. Okay, let me just check. Oh, I still have another adjustment. It's interest on loan. Capitalized has not been recorded. This was key, guys. This was key. This was key. I even did a different version of this. What I did is that I said interest capitalized was recorded. Here they said it was not recorded. I made mine to be recorded. Oh, that was so interesting. Must ask it. And then they said fixed monthly repayments, including interest, have been paid and correctly recorded for the financial year. Okay, good. And then they say interest on the loan amounts to 60% of the monthly repayments. This one was quite easy because all you had to do was just to check your loan balances. So your loan balance for last year was 690. Your loan balance for this year is 524,400. So the difference between these two will be your repayment. But in mine that I twisted, we call them spin-offs, ne? Yeah, but we'll get to that. This one was quite easy. This one was quite easy. So you just had to find the difference between those two values using the table, obviously. But when you use your table, there's interest table, which is opening plus your new loan, and then you minus the repayment. But here, please note that you didn't have to minus the repayment because they told you that the repayments have already been recorded. Okay. But anyway, all I did here was to compare the two because they said interest was not, it's normally the formula is opening plus your interest plus your additions minus your repayments. Okay. But now here they didn't say anything about additions. Let me just read it again. They didn't say anything about additions, and they told me that interest was not recorded. So these two amounts, in both these two amounts, interest was for this year was not recorded. So all I'm going to do is to find the difference between these two values. I didn't have to include the interest part as X here because it was not recorded to get the final value. Okay. If it was recorded, then I was going to say opening plus purchases. I mean, wow, why do I keep on saying opening plus purchases? It's opening plus additions plus interest minus repayments. And then I'll have closing. If the closing had interest, that formula was correct. But here the closing doesn't have interest. So that's why I will cancel interest. I will also cancel additions. That's why in between, you will notice that the only thing that I'm left with in between, or the difference between these two, will be your repayment. Now, after finding the repayment, which I found by taking that 524,400 minus in the 690, I realized that they said repayment, they said that 165,600, which is your repayment. This is my, please ignore minus interest of 40%. Okay, just ignore that because that was my twisted one. So that 165, of that 165, 60% of it is interest. So you'll take 165 times it by 60%, it'll give you interest of 99,360. Okay, because interest was not capitalized, I won't include that under, normally we'll include it under trading other payables, but in this case, it was not even asked. So what I'm going to do is to go to the bottom of my statement of profit or loss and just put my interest expense there. But before I put my interest expense there, I'm going to do something here. Because they're talking about interest and there's nothing about wages, I'm going to add all of these guys. Okay? All of these must give me that. Let's check if they do. 194,000 plus 1885 plus 219 plus 18 plus 281 plus 73 plus 4,700. Look what I get. It doesn't give me that 4,894,000. So I'm going to take this and take 4,894,900 and minus what I got there is the answer. It means that this is missing here. This missing value is my salaries and wages. Okay, but here's the thing. If I take my operating profit, my gross operating income, this one here, and I minus this one that was given to me here, it will give me my operating profit. Got it. But then I also have, I can easily work backwards. So I can easily get my profit before tax by taking my profit after tax, my adding it with my income tax. It'll give me my profit before tax. And then I will have interest expense, which is what we just calculated. It will be 99,360. When I add it with my net profit before tax, it'll give me my profit before interest expense. Now, operating profit, the difference between operating profit and profit before interest expense will be my interest income. How awesome is that? That is so cool, guys. That is so cool. Okay, let me just check what I'm left. I'm done with it. So I'm left with something here. I saw tax and I saw provisional payments. Remember provisional payments, it was 875,000. I said we're gonna come back to it. And our final tax was given to us here as 858,000. So our tax amount is less than provisional payments. So it means that the difference between those two will give us 16,860. It means that we have sales receivable, sales income tax receivable, because our provisional payments, which is 875,000, is greater than our final income tax amount, which is 858,140. And because of that, we're going to add 16,860 to trade in after receivables. Okay, so basically, this is what I will get. I will get my trade and other receivables as 764,140. So it's the same thing. I don't like it when they ask the same thing twice because it means if you struggle with the first one, you will definitely struggle with this one. So you will take 2896 010, add it with 764 140. It'll give us that, which doesn't give us that current assets. So I'm going to take the current assets value, which is, let me just find the total here. So I'll take the current asset value, which is 7,605,150, and minus it with the value that I've just calculated now. The difference will be 3,945,000. That 3,945,000 will be our cash and cash equivalents. So under current assets, we only have these three, which is your inventories, trade and other receivables, and cash equivalents. Okay. Whew. It's long and fun. Are we done? Yeah, guys, we done. Can you believe it? And that's how you will get your 100% in the final exam. Alrighty, I hope you enjoyed everything. Please don't forget to subscribe and watch the video. Um, if you really want me to continue with this paper, please watch. Invite your friends and ask them to watch. If it reaches 1,000 views, I will record the second part of this paper. All right, that's it from me. All I can say for now is Khozo.